Good morning, everyone. Today is September 26, 2023. Right after the Fed, the market has ended up going down, and I'm excited to show you what the market is doing this morning. So we have a here ability to show you on a FinViz how market has gapped down, it has moved lower, and of course the question remains how much lower we're gonna go. So what I'm planning to do this morning, planning to give you a big picture, and right after that we're gonna pull up the one specific ticker and we're gonna work an option strategy on it. In the meantime, if you can type in the Speak Up app the code that is on a screen, and then you can interact with me directly. So I'm typing right now, hello to you all. And if you are ready, I'm going to then start the technical analysis going over each of the components of uh, the stock market in the United States. The first component I want to discuss is the Dow Jones. And this Dow Jones is what really matters. What matters? Just one second. Hello, Jose. So what we are doing this morning. Sorry for a technical glitch over here, so we're going to continue, showing you the Dow Jones so you would actually see the low of the August 18th. So I'm showing right here no low of the August 18th, and as you can see, we have broken below the low of the August 18th, and that is definitely a bearish sign. So moving on to the next chart, this is a chart of the Nasdaq, which is represented by the QQQ. And this is a very significant level that we are on right now, because when you're looking at the low of the August 18th right here that I'm showing to you, we are not below it, but we are just about ready to touch it. So right now, in my personal opinion, it's probably the worst possible place to go short on a market, regardless of the fact that these other markets, such as let's say S&P 500, which is represented here by the SPY, has broken the low of the August 18th. So as you can see over here, we have August 18th, and we have, with some substantial power, broken into the downside. Same thing is in a Russell, because the Russell turns out to be the weakest of all these four markets. And here's the low of the August 18th. And not only that we have broken below it, but if you're looking right here, you would obviously see this huge gap. So market is going lower, but due to the fact that we have on Nasdaq not broken that level, I would highly caution all the shorts not to go shorts at the lowest possible point on a market. Now, of course, that cannot be seen just by looking at the blindly on a FinViz, for a simple reason that all that the FinViz does right here, it shows that we have another gap today, lower, and that we have made the minor bounce, right? So that thing by itself, it doesn't do anything to us in terms of knowing where we are going. So I have spent a lot of time preparing what can I do today on the September 26th that I can pull up, that I believe personally is at the low with the possibility of going higher. So I know I'm using the FinViz right here, but I want to type in the ticker that everybody probably already knows. It's the Chicago Board of Option Exchange. Now, when I show you the chart of the Chicago Board of Option Exchange, you're going to be impressed how good the chart looks. The chart is just ripping straight to the upside. Even with this huge drop that we had in S&P and a Nasdaq, CBOE is actually looking very, very good. So what I'm going to do right now, I'm going to be opening up options with options, and I'm going to type in the CBOE, and we're going to do a little bit of analysis of the CBOE before I introduce the real topic of today, which is a long synthetic. So I'm changing here CBOE on a daily, so you would see how strong CBOE is looking. So obviously over here, if you do the AutoClimate, we're going to see that currently for 6 days, we've been above this moving average, and this is a very good sign. Now, there was a small little pullback, but overall, like we don't have a resistance to the upside, but we do have a strong support right here where this unfilled orders are sitting around the 141.48. So what I'm intending to do this morning is very simple. I'm planning to pull up the option chain to go as far out as I can and to buy Auto Money call that I'm going to be financing with Auto Money put. Now, in order to make this as simple as possible, this is what, thank you for interacting with me. I really appreciate it. Is I'm going to drag in the Thinkorswim platform here. And when I drag into Thinkorswim platform, I'm going to execute that trade. And then right after I execute the trade, I'm going to actually walk with you piece by piece and explain it what I actually did, right? So I'm going right here in a paper trading account, CBOE. I'm ignoring everything but the furthest out expiry, which is January. And on a January, I'm going to reduce the strike prices to only 4 of them. So obviously, we're currently sitting at the 156.24, right? So if that's the current price of 156.24, what I can do, I can actually sell a put and buy a call. Now notice that the call is actually costing me $20.80. So in order for me to buy that for $20.80, I need exactly $2,800. Let me just make sure that I added this to be one contract rather than having the quantity of the 10 contracts. So I'm going down to the one single contract, right? And I'm placing this trade for $20.80. So that's tying up to $2,800, right? So when I send this thing in, that thing is going to get filled in a moment. And when I'm filled with that $20.80, I would then need to move ahead and finance that with the bid side of the 155 put. So as you're seeing here, I'm actually putting here 155, which just got filled over here for $11.30, right? So what we are doing right now, we are actually selling, and I'm going to make sure again that it sells only single contract and not 10 contracts of that particular trade. So $11.30 is going to finance some of that thing. So what we have in this particular case is that we are going to, okay, let me just change account here so this thing doesn't reject me again. So I'm going down to the one single contract, $11.30 is what I'm asking. $11.30 equals the maximum profit of the $1,130 with the maximum loss, because this is a 145 of the 14,370. Obviously, you would see in this account I have a $100,000, and now my option buying power has dropped in amount of only about 85. So once when I have that, what is really happening that my delta is exactly 1. And I'm going to walk you through that in a moment and just explain it to you how this thing works, right? So now I got filled for $11.70. That $11.70 of the capital has made my cash jump up in amount of $1,000 $170 minus the commission. And now I'm using that money to finance over here. If you can see it in this area, I'm financing in this area the buying of this call that I'm gonna point out to you in a moment here. So in a moment, I'm gonna walk through you through all the steps one by one without any confusion, and it's gonna be very clear to what we are doing here. So I'm gonna, for a $20.80 buy one contract, $20,080 I'm buying, so this is going to get filled, and then my delta is going to be exactly one. So having done this on a paper trading platform, I'm going to now just walk you through and explain exactly what we are doing here, walking step by step in a Word document, so we'll be actually able to see it here, what is going on. So we have a long synthetic, and this long synthetic started the account that had $100,000 of the paper trading account. After we have sold this put for $11.70. That brought in the credit of the $1,170, but as you can see right here, it's showing $1,169.35 because I'm paying for a commission 65 cents. So just be aware of it, that is a commission of the 65 cents that I ended up paying here, right? And that's why this amount has. Then what I have done, I have turned around and utilized that money to BTO or buy to open. And in this case, what did I buy to open? I bought to open 155 call that costed me basically $2,000, right? So that $2,000 of the $20 has created the synthetic position. Okay, so I just want to make sure that we're clear what the synthetic position is. So synthetic position is something that is superficially made. So what I could have done with this CBOE, right? Chicago Board of Option Exchange, that is currently trading at the 155 and some change, right? I could have gone ahead and bought simply the shares. So if I go over here and pull up the account here, and I simply go into this account and I buy the shares. So when I simply buy the 100 shares, right, what is that going to cost me? It's going to cost me the current price of the physical underlying. And that current price of the physical underlying is $15,624. So just be aware of it. This is what I could have done when the S&P 500 is sitting at the 156.24. That would tie up the $15,624. But what did I do instead of that? I decided to create a structure that is called synthetic long. And this synthetic long is composed of at-the-money call and at-the-money put. So I'm going to bring up again our platform here on Tradactive. And I'm going to open the option chain. And here's the CBOE. And when I close this and I go all the way to the furthest out expiry, so I'm going to select the expiration that is going to be January of the 2025. I'm going to reduce the strike prices only to the at-the-money level. So here's the at-the-money level strike price, and this at-the-money level strike price is what we are actually considering doing it for the January of the 2025. So we have a bid side and we have an ask side. So what I'm doing here, I'm placing this information inside here So everybody can see it, that when we have started here with this paper trading account in which we had $100,000, the call side of the 155 call was quoting $20.80, but I was able to get filled exactly for $20. So I was able to get the mid of the bid and ask. On a 155 put, I was a seller, and although over here it shows that I could have gotten the $12, I wasn't able to get the $12 because the bid and ask spread is 11.63 and the 12. I was able to get here, as you can see, $11.70. So I have gotten $11.70. So in the terms of what I'm doing here, I'm using the AutoMoney call and AutoMoney put to create a synthetic long, which gives me a delta of exactly 1. So instead of being an owner of this physical underlying and paying 1,500 624, right? As a buyer, I have created this superficial position that is composed of the long call and a long put. So we have a call here at the strike price of 155, and we have a put here of the same strike price of the 155. We ended up buying to open call, which gives us a delta of the 50. And over here, we're selling to open this put that also gives us a delta of 50. So net delta of our long 155 call at the same time short 155 put equals the delta of 1. So that means if the price goes up, I track this particular CBOE stock penny for penny without actually having the ownership in a stock. So when I pull it up here and show, I did it in an IRA account where both of my positions are open. So I'm going to just change the volume here to the actual position. So you would see that position. I'm +1 on a call side and I'm -1 on a put side, which means on the monitor tab, all that my buying power effect is 1550. So that right there, it's indication that I have saved money in comparison to actually having the $15,624 of the layout. So to make this a little bit more clear, what I'm going to do here, I'm going to create this as a spread. So I'm going to go over here where it says edit spread. I'm going to add one more leg and I'm going to alter this to match properly what we are doing here. So we bought January of the 2025 long call for $20 even price. That's what we got filled. And then we sold to open, same expiration, 155 put for a filled price of the 1170. So when I click OK and I have a projection over here, I get the difference of the two. So I'm going to just make sure that all this is clear here on a layout. And I'm going to put this again in a Word document. And I'm going to make sure that in the Word document, everything is looking good, right? So $20 of the debit minus $11.70 of the credit, I'm in the hole only about the $830 of the debit. And that's basically what is showing up right here on my account that I have started with $100,000. Now, when you subtract about 800, you will actually see that it is. So, under the accountant statement, I'm going to go step by step. So, I have started with the 100. I have received the credit of the 1,170, and then I went ahead and I purchased it, and that's why actually those numbers are exactly what they are. So this is now a part of the loan synthetic. I'm going to stop for a moment here, and I'm going to ask you if you have any questions to type the questions inside the Speak Up apps, and I'm going to then answer these questions as we go along. So, one more time, we are creating something that is superficial, that it doesn't exist. It's almost like a Frankenstein because it's composed of the parts. And my intention is actually to see this particular product go higher. And realistically, my real measurement, whether or not it's going higher, is what market has done in the down environment, such as today. Today is a down environment. When you're looking right here, um, majority of the technology stocks are down. Majority of the communication stocks are down. Consumers, you have like one bright spot, that's Nvidia. But Nvidia, this artificial intelligence, it's unable to actually hold everything up that is so weak. And when you pull up the CBOE, you will notice on the CBOE that we are actually not going with the trend, we're going opposite to the trend. So now this is where probably we're going to work on the downside protection, Joe, in a moment. But what I want to emphasize here, that you might walk through your mind and ask yourself, why in the world would this particular trader select something like this? First of all, reason why I would select something like this is that CBOE process all this 0 day to expiry orders that are being traded all the time, and liquidity of those is just absurdly high. For instance, if I type in the SPY right here, and I'm gonna just show XPX, I can type in the SPX, and when this thing shows up on the SPX, you're going to see the volume and open interest on these products, and it's just extraordinary. So, for instance, like volume on today's option for, let's say, few of these strike prices, it's in a 5 digits, and all of these options that you're looking, like they're gonna go out worthless, right? If you're moving any further out, you would see the volume actually drops. So all this same day expiry options are being processed by the CBOE, because these orders are filled by the CBOE. And just like our artificial intelligence, which is the only bright spot in this down market, which is represented by Nvidia, all this trading with the puts and the calls is being traded to the downside. Joe, I'm going to move on to the downside protection now in a moment, because I want to actually explain the step number one. So my step number one was very simple. I went ahead and I sold to open this this put, right? This put that gave me a delta of 50, right? So this was then cash secure put, and it has tied up basically $15,500, right? Did you choose to buy the call that is when it becomes in the money? Do you close the buy call? Okay, in this particular case, Joe, because I have Jeff, because I have so much time, I'm gonna actually do something better than that. But if I can just postpone your question and put it in the parking lot till I finish all the steps, you'll understand. I have a better way to do it. So answer to your question is yes. I will do something with that call, but it's not going to be on that cycle. Because what we have in this particular case, we have a put that is expiring in the January of the 2025, right? So is this call expiring in January of the 2025. So what I can do in this case, what you're asking me, it's a little bit ahead. I will be able to actually sell some call against it. So I'm going to be doing that strategy that is a Jose's favorite strategy, that is almost like a double diagonal. Yeah, I understand the buying power, but let me just walk through these steps, right? So step one, sell out the money, cash secured put. It provides you a credit. But the selling of the put is a double negative because it makes the delta into a positive. So one more time, if you're looking over here on a CBOE for the expiration of the January that we have, and instead of displaying here volume, what I'm going to do with the volume, I'm going to just bring up the delta, and you're going to see the delta is negative 45, but double negative makes negative times negative 45. So really, technically speaking, on that side, my delta is a 45, while over here on this side, delta is a 55. So if I really want to be completely accurate, so 0.45 is on one side and 0.55 is on the other side. Net, that still gives me a delta of what? Of 50. So my delta is being 1 when these two things are added. So let me just continue over here. Selling of the put, it's a choice, but it's also obligation to buy CBOE at that exact price. So that exact price that I'm taking obligation for $15,500 is about $1.24 higher than a current price. And I'm getting the credit in amount of $11.70. So I'm selling the longer term put that ties up that capital, but it's backed up by cash. So I have selected at the money put, and by default, my delta was a negative, but by selling the put makes it a positive. So that is a soft delta of the positive, right? So if I can now move on just to the next step, the next step is a buying of this long call, which is the first activity that I got filled in. And buying of the call produces a debit, and that was a $2,000 debit. So I was buying at the money call that was $1.24 in the money because the CBOE at the time was sitting at the 156.24, right? It had the delta of the 55 that I just explained it, and that 55 delta plus this 45 makes my physical underlying equivalent of the one. So it has the same expiry, and it was selecting the at the money option. So this execution was done virtually at 8 o'clock Pacific Standard Time, maybe like a few seconds apart, but it was done at the same time because I was making sure that this thing doesn't get away from me. So in the theory, my buying of the call was financed by the selling of the put, but hint, I still ended up in a debt of about $830. Now, I do have this. Let me just point out to you that outlay of the capital that is being tied up to the $15,500. And this is pretty much what Jeff was asking. What about the downside protection? What can we do about it? And this is why I'm moving to the step 3. So one more time, the step number 1 was either buying the call or selling the put. But these two steps equaling the first step. The second would be buying of the out of the money put. So when it comes to buying of the out of the money put, I know that a lot of people like, well, I'm not sure which one to select. There's a simple rule of the thumb that I use. If I ended up paying for this about 11, I want to get back about the half of that. And a half of that would equal the 135. Okay. So now this is just a blind thing, but what you can actually do, that you can start looking, what is the open interest? What is the open interest on each of these strike prices? So when you're looking like at the 135, which I'm saying it's kind of textbook example that Larry McMillan has explained in his book Option as a Strategic Investment, you would see that any of these other ones, and I'm going to just change the color in the red so it would kind of stand out. The strike price 125 has an open interest of only of the 15. The reason why I'm not showing the volume, because the volume is zero on any one of these, right? So there's only 15 contract. So in that case, if I have here my 155 that was done here for 11, this 440 wouldn't do the trick. It just wouldn't do the trick. So that 440 is not a good choice. If I now move on to another selection, and again, another selection would be 130. And so like, well, it has a 55 open interest contracts. And if I have traded this one, which I sold for about the $11.70, I'm still not getting half of it by getting about the $5 of the mid price between the bid and ask on 130 put. So that's not a good choice. If I by any chance, again, consider getting more money, which is not necessarily what Larry McMillan explained in his book, Option as a Strategic Investment, because we are here at 11 and we ended up getting here 7. So when you subtract these two things, you're like, well, I'm ahead of the game. I offset it. Look at again the volume. The volume is again in the 2 digits. So the previous traders who are trading the long synthetics have already selected for you the correct selection of the which buying of the out of the money put you should do. And that buying of the out of the money put is what? It costs money because now I need to pony up additional. Let's say if I get filled here for $6.30, right? Let's just say I'm gonna get filled for a $6. I hope I'm gonna get filled for a $6. I just need to make sure that my contract is down to a single because I'm here in a simulated trading account and I'm buying for $630. That's gonna reduce my buying power to $83,668 if I get filled. So I'm sending this in, and now it's a working order, and I got filled at the 6. So I'm going to make sure that I have that as a part of the information right here that explains that at 8:32, it's about the 20 minutes after we got filled, I have jumped in for a $6, and I'm going to just put that right here. So this is a step number 3, which is exactly what was asked here, like is this downside protection? So this is a downside protection in case I'm wrong, in case the market doesn't go up for some reason, it starts going down, which is very possible. Just be aware of the fact, market as of now, it's going down. What's the CBOE doing? It's still up for a day. Now, it's not up as much as before, right? But, tides are either pulling all the boats up or down. It's possible that this thing might go down, right? But I have obligation to buy something at the 155 if this thing comes down to 155. Now, look, would you agree that whoever has selected the 135 has selected the 135 at a very significant technical level? Well, let's bring up our platform here, Tradactive, just to match this, because I would not be surprised if on a Tradactive we're showing a significant level of the UFOs at that particular level. So let's pull up our Tradactive platform. I'm going to just get rid of this for a second and look at the 135. So we have actually at 128, we have some UFOs, but just before the 135, we have these green unfilled orders. So buying a put, which gives me a right to sell the stock at 135, is exactly at the correct technical space. So if you have any objection, please feel free to type in the question, objection, any of this, because I want to tell you all that I'm showing you right now, that I'm following the big footprints of the institutions for whom $15,500 is money that they can park for over a year and not even worry about it. Because where is this thing located? It's located in between the two green unfilled orders. And I will actually make sure that I put these orders right here in this Word document so you would understand that whatever we saw on the FinViz, we back up with the threat active platform, and we're seeing that there are the green unfilled orders and they are not expecting it to be broken. So therefore they have picked a solid level right there. So if I now look at my Thinkorswim platform, what has happened to my buying power effect? My buying power effect has been reduced due to this activity from a $15,000 down to $2,000. And as you know, we have this rule that out of the $100,000 account, uh, we should risk only 2%, right? So when you say 2%, I'm sorry, 2%, what is that equaling? Well, that's equaling what? $2,000. So with this downside protection that Joe Peoples has asked me, I was able actually to reduce the $15,000 to $2,000. So if this is good, or if you have any other question, please type it in. Okay, my buying power effect stays, and why is the difference? Okay, why do we have a difference here of the $2,000? So if I actually bring again uh, the Thinkorswim platform just to show you the difference of the two, 135 and 155, okay, is $20. That's what it is. So I'm going to go back to the Trade Active. I'm going to build this, how this could have been done, so it's kind of easier to understand it. I could have selected, instead of the long call, just a bull put spread. And now when I go to edit the spread, I know the numbers. I know that I'm trading the expiration for 2025, and that I'm actually selling the 155 put and buying the 135 put. That buying 135 put was done for $6. So we got filled for $6. $6 even. But selling of the 155 was filled at what? 1170. So if I go over here and I click that, you would see now when I over here go to the risk graph that the difference of the two is exactly what I was talking to you. 1170 minus 6 is a what? 570. So what I'm having right now, it's a bull put spread if I just look at these two particular strike prices. So could we place this different than synthetic? Yes, we could, but I really want to say to you, that takes away your focus of what the real in synthetic is. Real synthetic is the two deltas. Positive delta from a call and double negative delta from the put. That is what you need to be focusing on. But then, as Joe pointed out, it's like, wow, like after the buying put, you only are risking a $2,000. Yes, that's all that it is. Now, be aware of it. There's this third step, and this third step was buying of the put that has this long call. So I'm not sure if I should actually put all this inside of this document, because this document is actually tracking the logic, right? So the step one would be you do either the call or you do either the put. In this particular code, on step one, I bought to open a call, okay? I know normally you could sell to open the step two, right? The step two equals sell to open a put. But honestly, net, it comes to the same thing because it needs to be done simultaneously at the same time. We're talking about executing this at 8 o'clock. And then about what, 30 minutes later, whatever, 32 minutes later, I decided to follow what Joe was asking. $15,000, that's a big chunk out of a lot of traders' accounts, especially if they're trading what, only $25,000. If they're trading with $25,000 and they put in 15,000, that's already shut the account more than 50%. But how do we offset that? We simply bought. We bought the put that cost the money, but keyword, it reduced the outlay of the sold put. So initial buying was done at the 6, and you saw me when I clicked there, get me at 6:30, but I got filled at the 6. Why? Because the CBOE has now this artificial intelligence in place that they're fishing with the market makers trying to find the best possible fill, and then they're getting filled for what? For that particular price. So due to this bid and ask spread, uh, it's better that you are entering first that spread that I was calling about the long synthetic, and then come down and do this put at the lower strike price than what you got filled at the higher one. So we are getting filled at the 155 put, and then we went ahead and we did this 135 put. Now again, be aware of it. If the market goes below the one, whatever we were measuring there, then this 135 put starts having some value, right? So this bull put spread that I'm having shouldn't even be considered as a bull put spread, because all that I have here is a bull put spread that is completely, and I'm going to do this one more time just to make things simple. Instead of the delta, I'm going to select the intrinsic value. So watch how much intrinsic value of the 135 has. Nada. But if the price action drops below those green UFOs, if we really lose this level, I mean, just think about it. The stock that is currently at 155 moves below the 130. That's about the $15 drop. Okay, so let's do the math. $150 stocks, $15 drop. What is that? That is a 10%. That is a concern. It's at that point that I might say, okay, CBOE was wrong. It was in an uptrend. It's no longer an uptrend. We are breaking this uptrend. In fact, I need to do something about it. And that's how we're going to work our way out through this long out of the money put, which became out of money and in the money when the price has what? Dropped below. When the price has dropped below. I mean, you can play with that, with the TO price if you want, like if you have a time to do it, like so you can go over here and say theoretically, if the price of the stock drops by $15 negative, right? $50 down in a negative side, what would that do? And then you see the theoretical price on this thing would be about the $10. So you pay for something $6. If this drops $15, this would make you about the $4 of the value, because at that point we are dropping from 155 down to 130, and your 135 put at this point has the theoretical value of the $10. But if this thing drops, let's say $20, okay, so we're looking at the $20. How much of this value would be inside of this 135 for which you paid $6? It would be about 12. So here's my question: when something doubles, when a $6 becomes $11.95 or $12, are you going to consider yourself loser or a winner on that one? And I'm talking about just that one leg. You're up 100%. You should be dancing all the way to the bank. But what is happening on the other legs? Well, what is happening on a call, we're going to discuss it in a moment, because we can do something against the call. And what can we do against the call? Well, we have a long call. And in terms of the long call, we can sell the call. Now, here's a question for everybody. What kind of call should I sell? I owe January 2025. Should I sell the front cycle or should I sell the 2025? Yeah, Joe, you're dead on with your comment. I really think you're getting this. And again, I suggest you even find one of these long synthetics that I have done, I don't know, a couple of years ago when I started with Jose to trade active, and just watch the whole thing. I have a slides there, I have explanation. All that I'm doing right here, I'm making the practical application of it. So I hope, Joe, you understand what I'm suggesting. Go on to YouTube, type in long synthetic thread active, and you would see it right there, and you can just walk through it. So we can sell the front cycle, and that would bring us some credit, right? So now be aware if that's then diagonal, because we're not selling the 155, we're selling something lower, we're selling the 130 or something like that. Okay, for all the practical purposes, let's just talk about, okay, what do I have? I have a September 29. Could I sell something for a September 29? And let me now again just clear this up and look at the volume and open interest. There's only two trades done today. And I wouldn't be surprised those two trades that were done today that there was some kind of bear call spread. Let me just see if somebody fired the bear call spread. Yeah, they got the 50 cents on it. So they got the 50 cents and they were risking the what? $2. Okay, let me just edit this so it can be on the one so you will not get confused on it. So somebody went ahead and it says, hey, you know what? I'm going to make a 50 cents in about the 2 days, because in the September 29, 3 days, I'm sorry, expiry is going to come. So they're risking the $200 to make 50. But I don't need to do that, ladies and gentlemen. I could place this trade, but then that would detour us from what we are teaching today. Today we're teaching long synthetics, so let's not get into the bear call spread and any of these things. But just think about it. If you're in that situation, that something is going against you, and you have a certainty that you bring up the chart, I'm going to just move this away, and I'm going to just move this away. I'm going to float this, and I'm going to go back to the CBOE, and I'm seeing like, well, 157, I don't think 157.50, I don't think we're going to go above the 157.50, especially because the market is down right now. We only have a Nvidia that is holding up the entire U.S. stock market. That's only green. Well, actually, you know what? Not even Nvidia nor the Tesla are green. So this is definitely going to pull down the CBOE, because S&P 500 is down 1%. So is the Nasdaq. Dow is just about ready to go down 1%. Yeah, you know what? I feel safe then selling it. So what we can do in that case, we can go ahead and sell it, but just sell it for that cycle. Do not go out and sell like greedy, like, why would I get only 60 cents here when I can go over here on October 6th and get the $1.35? That's almost double. Yeah, but are you sure that the 10 days from now, the product that is basically sitting at the 155.50 cannot move $2? I mean, stop and ask yourself those questions, because answer is right here in front of your eyes. What is the market maker expecting that in 10 days, the CBOE can do? So take a look. CBOE in 10 days can definitely move $4. So if you know that CBOE can move $4, why in the right mind do you want to sell the 157 when we are sitting here at the 155? Because that means that you're only looking at the move of the $2 up, or move down of the what? $2 down. When this thing can basically rip $4.72. So I would actually feel more comfortable. And I'm going to escape all this to trade against my long call that I paid $20 even, because that's what I got filled. I'm going to go ahead and sell this for 60 cents. So be aware of it. This might be confusing, because as of now, I have a long call and I have a put that is offset. the buying of the put versus of the selling of the put. In a moment, you're going to see the red line here when I go ahead and sell this, and make sure that you change this to the contract side that you do want to trade, which is just one. And I'm bringing 60 cents. I might get filled at 75. I'm going to be very happy. But, being the paper trading platform, I really don't know if that's going to. Okay, yeah, it's saying to you, like, oh, we are working to fill you at 60, but in reality, mid prices is 75. So I'm not going to be wasting time here waiting for this thing to get filled. But what I want to tell you that the beautiful thing is, okay, let's just stop and think about it. How many more of these weeklies could I do? Okay, let's not talk about the weeklies. Let's just assume monthlies. I got filled at 75. Bingo. Bingo. Okay, let's just keep the thing simple. Okay, let's just keep the thing simple. We own January 2025 call, against which we could sell at least 12 times, meaning in 2024 there are 12 months, and I can sell the 12 times. Okay, a short call. And let's say if that short call giving us only $1, let's just assume that my cost was at $2,000, correct? I go ahead and I sell for $1 times 12 times. What am I getting? I'm getting the $1,200. Did I not pay off my call? I didn't, because I still have a what? Debit of what? $800. Hey, but Josip, you have forgotten. We still have it in 2023. We can sell October, we can sell November, and we can sell what? December. So if you sell December, again, everything for $1, right? That's times 3. Isn't that what? $300. How much we're in a debit? We're in debit, 800 minus 300, what? Only 500. And these are those rough estimates. So Joe, Jeff, Mark, do you see what I'm trying to lay out to you? This is a completely different mindset than 0-day trading, which means I want to fire this in and I want to be right. I want to be right now. This is a mindset that you should adopt as if you're owner of, let's say, mobile park where people can never own the land. So they own the mobile homes and you own the land, and every month they need to pay you a rent on the land, and no matter what they do in their lifetime, they can never pay off that land because all that they pay off is just that mobile home. But you're constantly getting income in and getting income in. The reason why this particular cycle was selected, because there was no January of the 2026. When a January of the 2026 comes, then why don't you just go ahead and get that one? So I'm looking at the time. It's 8:53. I'm going to repeat everything that I did on another stock that, if I'm not mistaken, like several years ago when I did that stock, in a presentation, it was American Airlines. So if I'm doing this on American Airlines, I have June of 2026, 996 days. And look how many of these weeklies do I have. If I just every week do the same thing that I was saying to you, sell something, sell something, sell something, I can milk the American Airline to the point that I can have at least one free flight anywhere, whatever the American Airline flies every single year. So what is the step number one? Step number one, you go ahead and pick the ATA money. So here's the question is, what is the ATA money? If you're sitting here at the 122, to $12.85, I can pick the 12. So what I'm doing on the 12th is a single right clicking to sell one single. Okay, that's what I'm gonna tuck away. Okay, so now what I'm doing over here, I'm getting $2.35 that I'm gonna invest to buy the $4.50 of the $12 call. Okay, I need to make sure that this doesn't say 10. It says what? 1. So I'm doing the 12 call and I'm doing the 12 put, but this is being sold, this is being bought. Only debit out of me is what? $1.95. Now I'm going to confirm it, but I'm going to go into different account. I want to go into margin account, okay? Because I want to show you these things over there so you'll understand it. So I'm firing the things in, and of course, I need to wait here a little bit to get filled at that level. So soon as I get filled on that level, I have an ability to look at the volume and open interest and to figure out where could I go lower to offset my put. Well, the only problem that I have with this particular underlying that I don't have a strike prices at every level. I don't have it at 9, I don't have it at 7, I don't have it at 6, but below 5 I have at every level. So if I got here about the 250, what should I get back? About the $1.25. So if I should get $1.25, then what I would do in American Airlines, I would actually ended up buying the 8. Okay, so let me now recap this, okay? So this is completely new example. American Airlines is currently sitting at the $12.86. I'm going to use the same concept that we did over here into the close, that I went ahead and I bought to open 12 call. And over here, I sold to open 12 call. But what I'm going to do next, I'm going to be buying to open over here $8 call. And when I buy the $8 call, I reduce that $1,200 to only what? $400. How do you get to $400? 8 minus 12 is what? 4 times 100 because of each contract. So basically for $400, I'm controlling the stock American Airlines to June 2026. By then, election is over. By then, shutdown is over. By then, I don't know, whatever is over. American Airlines has the same name as the Bank of America. Therefore, Bank of America was saved while the WAMU fell apart because it had a bad name. But think about it, all around the world, who prints money in England? Bank of England. Who prints money in New Zealand? Bank of New Zealand. Who prints money in Canada? Bank of Canada. Who prints money in US? Feds. But the Bank of America didn't collapse because they have a name of what? Bank of America. Let's say all the airlines are collapsing. Oil is through the roof. Delta collapses. Southwest, blah, blah, blah. Hawaiian most likely is not going to collapse because the government of Hawaii is involved in it. But what is the one airline that our feds might prop up? What's the name of it? American Airlines. Most likely that's the one they'll say. That's again assumption. It's a presumption. But I'm looking at this, it's June 26th. This long-term synthetic is going to work out. But if it doesn't work out, what can you do right here? Sell to open something that is out of the money. And the best thing is you can do it every single week. Every single week. Every single week. I'm sorry. You're right, Joe. I misspelled it over here. It's supposed to say put. I'm wrong, right? Because over here you get the delta of 50. Over here you get the delta of, of course those things vary, delta of 50. But over here you have a long synthetic and you have a delta of what? Of 1. So just be aware of it, that that's a positive one. So it doesn't matter if the one side we got this and the other side. So again, I know I threw so much at you, but I would highly suggest dig out of the Trader Active website long synthetics that I did way back when, at least a couple years ago. Watch it. At the end, I brought up the same example of American Airlines. I fired the things in. Now, again, this is a paper trading account because everything that we do here is for educational purposes only. Oh, I see now. It says a delay date, and I wonder why that thing is like that. But I'm going to stop the recording. Please rewatch that in the future. And if you have any questions, you know where to contact me. It was down here, joseph@thetradeactive.com. And I'll see you probably next month. And stay hedged and trade wisely, and be aware of it that government shutdown might happen and the market might be very volatile. All the best.